Okay, let's dive right into this. Today, we're breaking down a concept that is going to completely rewire how you look at market data. We are unpacking the SRBMPR framework, that's Structural and Rule-Based Market Pattern Research. And our main goal for this explainer, a total perspective shift. We are going to step way back from simple directional price action, the classic is the chart going up or down mindset, and instead we're jumping into the incredibly fascinating world of structural market topology.
To really anchor this whole exploration, we have to start with this core axiom right here. Behavior gives birth to the candle, not the other way around. Seriously, think about that for a second. It's absolutely fundamental. It's telling us that we have to look past the traditional trading metrics. We need to look past the standard open, high, low, close data points to find the true underlying mechanisms at play. Because let's be real, the candle's just a footprint left in the mud. We are here to study the creature that's actually making it.
So, here is our roadmap for today. We're going to briefly walk through these 5 steps to deconstruct this highly academic framework, starting with moving beyond simple price, all the way down to validating the topology with hard data. Let's get into it.
Starting off with Section 1, Beyond Price and Direction. We really need to challenge the status quo of how quants normally analyze the market.
Think about what we've been doing up until now. We've relied so heavily on a basic binary model, right? It's either bullish or bearish, up or down, left or right. But here's the problem. If we only use those 2 buckets, we are literally collapsing a massive amount of valuable, granular information. The new way uses behavioral topology. We are looking at state, transition, and transfer. We aren't just labeling a direction, we're actually classifying the internal structural sequence of the move itself.
Let me put it this way. A 1, 2, 3 sequence, that isn't just an up pattern. It's an internal behavioral grammar. It's a structure. And here's where it gets wild. That exact same structural relationship can show up in the opposite direction, like a 3, 2, 1. So, we have to separate the behavior from the direction. When the market reverses, that internal grammar is preserving itself, even as the trajectory flips. You're basically looking at a continuous behavioral sequence family, not just random price swings.
Which leads us perfectly into Section 2, Mapping New Behavioral Symmetries. I want you to completely reconsider what is actually happening when a market trend shifts.
Imagine a biological cell moving from one spot to another. Normally, you'd just ask, well, where did the cell go? But that's the wrong question. We should be asking, what was the internal state of that cell, and is that exact same behavioral mechanism reappearing over here? If we apply this to the market, a reversal itself isn't the primary object anymore. We aren't just tracking where the price went. We are tracking how its internal energy and behavioral state actually transferred to a completely new location.
And this brilliantly illustrates the shift. We are going way deeper than just basic left versus right. First, you identify the location. Then you map the relational transition, like moving from left to right. And finally, you track the internal state transition, like a 1 to 2 sequence. It's a nested classification. We're pulling apart the topology layer by layer.
So this right here is the absolute game changer. We aren't tossing data into 2 basic buckets anymore. We are looking at an 8-part hierarchical decomposition. You've got left to left to right to left, and right to right. And nested deep inside every single one of those are the 1, 2, 3 state transitions. What does this mean? It means we are finally identifying behavior by its internal transformation, not its directional result. This specific transition class hierarchy is what allows us to truly map these deep market symmetries.
Now that we've wrapped our heads around the topology, let's look at Section 3, the zero-cycle engine. This is the formal mathematical engine powering this whole thing. The SRBMPR framework runs on a very strict, non-destructive 7-stage pipeline. It takes raw market data, detects the rhythm, reconstructs the context, extracts the behavior, isolates what we call the zero cycle, formats the dataset, and finally outputs AI understanding. The beauty of this pipeline is that it takes raw, chaotic market activity and turns it into structured intelligence entirely without relying on those standard lagging indicators everyone else uses.
As you can see, behavioral extraction in this framework physically isolates these measurable sequences. Specifically, it maps higher lows and lower highs. It treats them as the atomic units, the fundamental building blocks of the research, so we can finally analyze them structurally rather than just guessing based on a chart shape.
And the heart of all this, the zero cycle. By definition, this is the foundational research unit. Think of it as the invisible seed of market behavior. Quantitatively, it's a fractal swing high and low that forms within 8 bars or less, with a super tight price tolerance of 0.15% or less. I mean, that is microscopic. But this tiny structure is the engine room. It literally carries the genetic code for the market's entire next move.
All right, moving to section 4, left behavior, right reaction. If we want to make sure this whole behavioral theory isn't just us seeing shapes in the clouds, the framework has to strictly categorize data to prevent hindsight bias.
This is the causal boundary. It's absolutely crucial. Left behavior is your historical data, the current rhythm where the original trend is perfectly intact. Right reaction is the future outcome, where a brand new sequence begins and the behavior has definitively shifted. The entire bedrock of this research relies on the absolute, unbreakable separation between the structural context on the left and the post-gap movement on the right. You can never, ever use the right to predict the left.
To measure this cleanly, the framework uses a strict data division rule with fixed anchor points. So, for example, you might take a monthly high as your origin point, right? And then from there, you test the 1-minute internal behavior flowing out of it. By locking down these anchors, we can test across completely different timeframes to pinpoint exactly when the left behavior transforms into the right. So, we have this beautifully complex theory of state transition symmetry. But how do we actually prove it? Let's hit section 5, validating the market topology with cold, hard data.
The backtest results from the MT5 simulation are honestly pretty staggering. The framework detected valid behavior at exactly 4 monthly formation points. All 4 of those produced profitable outcomes. That's a 100% win rate. 0 stop losses were hit, 0 drawdown on the closed trades. But wait, here's the most important metric on this whole list. The system automatically rejected 10 formations simply because they lacked the proper internal behavioral sequence. Rejecting those 10 setups is the ultimate proof that this is true behavior validation, not just curve-fitting a model to look good on paper.
Just take a look at how meticulously this data is logged in the 1-minute gap behavior report. You've got the exact missing start timestamp, the pre-gap direction, and the locked-in hypothesis, whether it's long, short, or none. Every single piece of this left-side behavior is permanently recorded before the right-side gap outcome is ever measured. That ensures total, undeniable research integrity.
Now, you might have caught earlier that no stop losses were hit. There's a very specific reason for that. The framework uses MFE, or maximum favorable excursion. It essentially lets the price run its unconstrained path without clamping it down with a risk-managed trading strategy. By letting it run wild without arbitrary stops, the researchers can study the pure, natural life cycle and transfer of these topological behaviors.
Which leaves us with an incredibly profound research question to wrap up on. Does market behavior only shift after a complete phase? And if we change the time frame, does that deeply symmetrical internal behavior remain exactly the same, merely changing its speed? Are we just looking at different directional manifestations of the exact same underlying mechanism? It's a question that challenges literally everything we think we know about financial data. Thank you so much for joining me on this deep dive into market topology. See you on the next explainer.